and welcome to Hilltop Wealth Advisors Economic and Market Update for the second quarter of 2023. I'm Brittany Brinkerhoff here today with Ben Yeager, and it has definitely been a surprising start to the year with mixed economic data and news, but better than expected stock market performance. So Ben, why don't you talk us through some of the trends that we've seen so far this year?
Yeah, so we've definitely seen some mixed global economic growth, but albeit growth. And some of the positive news is that inflation has been decelerating, and we're starting to see some movement there. Um, Overall, markets in the first quarter started the year with lower valuations, and that led to some outperformance in the U.S. growth sector, particularly tech. And then we also saw some of that in the developing markets overseas in Europe. As far as the US is concerned, the banking sector crisis has really dominated the headlines. Some of the small regional banks are struggling with the sharply higher short term interest rates that we've seen. And there have been a few that had needed to be taken over by regulators and even bought by larger banks. And as I mentioned, it's really these higher interest rates that are causing most of the trouble here. The Fed has now raised rates a 10th time in just over a year, and this is the fastest pace increase since the 80s. Now we're looking at where they might be going from here, but we're at a high level now, and that has definitely impacted several sectors, including the housing sector, which has slowed a little bit due to higher mortgage rates. Supply is still pretty low, so there's some strength there, keeping prices at a more moderate level. Labor market also is tight. Participation rates are almost back to the pre-pandemic levels for prime age workers. Job openings are down though, and the labor market as a whole is smaller due to the decline in immigration and baby boomers retiring as well. Inflation, as I mentioned, has continued to moderate and is now down to 5% for the overall headline inflation. Some of the areas in shelter and core services have been a little more stubborn, but we may see that start to break up a little bit as we move throughout the year. For the first quarter, U.S. economic growth came in at 1.1%, which is a little less growth than we had expected, but albeit growth, so we'll take it. And the US dollar has moderated a little bit with the higher interest rates and slightly slower growth rate as well this year. As we look overseas in Europe and China, Europe particularly fared much better than expected over the winter. They made it through that energy crisis that many were concerned about. And then China has started reopening as well. And so we're starting to see a little bit more movement in their economy as well. So Brittany, what would your outlook be here for the rest of the year with all of these different environments that we're dealing with?
Yeah, there really is going to be a lot that we're keeping our eyes on. And as you alluded to, economies across the globe certainly seem less synchronized, and we think that trend is going to continue. So in the US, we think that inflation is going to keep slowly coming down. We also think it's possible that we've seen the end of the interest rate increases from the Fed. Both of those things sound like good news, but we do think it's more and more likely that the US might slip into a recession before the end of the year. And that's driven by a few different factors, one of which being that banks have continued to tighten lending standards, but also that businesses are slowing their pace of hiring and capital spending. A lot of that is because of recession fears, but as a whole, that's just going to decrease business spending across the board. Corporate earnings are expected to be flat or negative for the year, largely due to higher costs, partially because of interest rates, but also because of cost of labor. And at the same time, US consumers are spending more, saving less, and building up credit card debt. And we'd expect that trend to continue as well. So as a whole, we think we might see some signs of cooling in the labor market. And this might also impact the interest rate environment going forward. So as you can see in this JP Morgan chart here, you can see the historic changes in the interest rate. But on the right-hand side, you can see the different projections of where the rate might go. And it's certainly possible that the Fed might need to cut rates in 2023 or in early 2024. However, if and or when we do see a recession, we think that it will be fairly mild, assuming, of course, that the question about raising the debt ceiling gets resolved smoothly. And we do think that it will, but we also think we'll see more volatility as we get closer and closer to that deadline. So as a whole, we think it's likely that global growth might outpace that of the US, at least in the short term, although economies across the world will be trending in different ways. So Europe, for example, we expect that they might see some more headwinds as a result of their monetary policy tightening. But it does look like inflation might have peaked in Europe, so perhaps the interest rate increases will slow and stop there. But if we see a recession in the US, that would certainly impact European countries as well. On the flip side, China, like you were mentioning, has been expanding as part of their post-COVID reopening. And it's unclear how long or what the magnitude of that expansion might be, but they're certainly in a different phase of the business cycle. As a whole, though, we really anticipate volatility, so we will be watching things cautiously, but also looking for opportunities. So Ben, why don't you talk a bit about how Hilltop is positioning given this environment?
Well, yeah, with all the uncertainty out there these days and the volatility that is expected, particularly over the next couple of quarters, we're favoring more defensive sectors like healthcare and our equity allocation. International, we're seeing some opportunities in large cap US as well. And with the higher interest rates, with the Fed, pushing interest rates even higher, we're in potential for rate cuts here in the future. There's a real opportunity in some fixed income areas as well. So there are opportunities out there, but we are leaning a little more defensive with the uncertainty and keeping our eye open for further opportunities that may present themselves. One thing we want to stress in this type of environment are really two things. One, you want to make sure that you have a strong cash reserve, and cash these days is actually paying you to hold it these days. So it's actually not a bad asset to have for those short-term needs that you may have, coming up over the next 6 to 12 months. And then outside of that, you want to remain invested. This chart from Fidelity, it's a periodic table of returns, as they call it, and it shows different asset classes and how they have performed year over year. And the important thing is not to necessarily zero in on each year or each asset class, but see that there's a rotation. Typically, areas that do better for a couple years tend to do worse a few years after that. And so it's really important to have a diversified mix in the portfolio and make sure that you're spreading your risk, but then also looking for those opportunities as they present themselves. So number one key is remain diversified.
Yes, I think that is really the key thing to be thinking about here and over the coming months. Well, thank you, Ben, and thank you all so much for watching. We hope you enjoyed this and learned something. If you're not working with Hilltop yet, know that we are always happy to talk with you. But if you know someone that is concerned about their portfolio or the stock market, now is also a great time to put us in touch with them. You can learn more about us on our website and the Hilltop Views blog. Thank you.